Welcome back to our channel, where we will be diving deep into the terminologies that are essential to help you get ready for your financial certification exams like investment funds and Canadian securities. Whether you're gearing up to tackle your exams head-on or just looking to boost your financial vocabulary, you're in the right place. Don't forget to hit that subscribe button and ring the notification bell, so you never miss an update from us. As always, remember to like, comment, and share your thoughts. Now, let's begin. Blue sky. Blue sky is a colloquial term used to describe laws implemented by different Canadian provinces and U.S. states to safeguard the public from securities fraud. When a new issue of securities has been approved by a Securities Commission and is eligible for distribution, it is said to be blue-skied. This term indicates that the offering has been vetted and cleared by regulatory authorities, providing a level of assurance to potential investors that the securities meet certain regulatory standards and can be legally offered to the public. Bond. A certificate evidencing a debt on which the issuer promises to pay the holder a specified amount of interest based on the coupon rate, for a specified length of time, and to repay the loan on its maturity. Strictly speaking, assets are pledged as security for a bond issue, except in the case of government bonds, but the term is often loosely used to describe any funded debt issue. Bond contract. A bond contract is a legal agreement between the issuer of a bond and the bondholder. It outlines the terms and conditions of the bond, including details like the principal amount, coupon rate, maturity date, payment schedule, and any associated rights and obligations. The contract serves as a binding document that governs the issuer's responsibilities to make interest payments and repay the principal at maturity, while also specifying the rights of the bondholder. Bond fund. A bond fund is a type of investment fund that pools money from multiple investors to invest in a diversified portfolio of bonds. Managed by professionals, these funds can invest in various types of bonds, such as government bonds, corporate bonds, municipal bonds, or international bonds. Bond funds provide investors with exposure to a wide range of fixed-income securities without the need to purchase individual bonds. They offer potential income through interest payments and the potential for capital appreciation if bond prices increase. The value of bond fund shares can fluctuate based on changes in interest rates and bond market conditions. Bond indenture. A bond indenture is a legal contract between the issuer of a bond and the bondholders, outlining the terms and conditions of the bond issuance. It includes important details such as the bond's principal amount, interest rate, maturity date, repayment terms, and any provisions or covenants that both the issuer and bondholders must adhere to. The indenture provides a clear framework for the relationship between the issuer and bondholders, ensuring that both parties understand their rights, responsibilities, and obligations throughout the life of the bond. It is a crucial document that safeguards the interests of both parties and helps maintain transparency and consistency in the bond agreement. Bond residue. Bond residue refers to the principal portion of a bond that remains after the individual interest payments, also known as coupons, have been stripped or separated from the bond. When bonds are stripped, the coupons are removed to create individual securities that represent the future interest payments. The bond residue is what's left, representing the original principal amount of the bond. Stripping bonds can be done to create different types of securities with distinct risk and return profiles. The individual coupons can be traded separately from the bond residue. This practice is often used in financial markets to facilitate trading and meet specific investment needs. Book value. Book value refers to the value of an asset as recorded on a company's balance sheet, typically its historical cost minus accumulated depreciation or amortization. It represents the net worth of an asset according to the company's accounting records. Book value can be used to assess the value of a company's assets, and is often compared to market value to evaluate whether assets are undervalued or overvalued. It's important to note that book value may not always reflect the current market value or the actual worth of an asset due to factors like depreciation, changing market conditions, and other considerations. Bottom-up analysis. Bottom-up analysis is an investment strategy that involves examining individual stocks or assets first, and then using the insights gained to make broader investment decisions. In this approach, investors focus on the specific characteristics, financial health, growth prospects, and other details of individual companies or assets. These micro-level analyses are then used to form an overall investment strategy, rather than starting with a top-down approach that considers broader economic trends or market conditions first. Bottom-up analysis is often employed by fundamental investors who believe that a strong understanding of individual assets can lead to successful investment choices. Bought deal. A bought deal refers to the situation where an investment dealer purchases a fresh offering of stocks or bonds directly from the issuing company. The investment dealer then proceeds to resell these securities to its clients. This commonly takes place through methods like private placements or short-form prospectuses. Notably, the investment dealer assumes its own capital at risk in this arrangement. If the securities price needs to be decreased in order to ensure their sale, the investment dealer takes on any potential losses that may arise. Bourse de Montréal. The Bourse de Montréal, commonly known as the Montreal Exchange, focuses exclusively on financial derivatives such as options and futures related to non-agricultural commodities. This exchange provides a platform for investors to trade a variety of financial instruments, including options that were previously traded on the Toronto Stock Exchange and futures products that were formerly traded on the Toronto Futures Exchange. By facilitating the trading of these financial derivatives, the Bourse de Montréal contributes to the functioning and diversity of Canada's financial markets. Broker. A broker is an individual or a registered investment dealer who has the authorization to trade securities. They can act as agents, representing clients' interests, or as principals, trading on their own behalf. Importantly, brokers must be members of a self-regulatory organization, SRO, such as a stock exchange, and they play a key role in facilitating transactions within the financial markets. Broker of record. A broker of record is the broker officially designated as the primary advisor to a corporation regarding financial matters. This broker holds the privilege of having the initial option to purchase any new issues of securities that the corporation decides to offer. This designation establishes a formal relationship between the corporation and the broker, granting the broker certain rights and responsibilities in handling the company's financial affairs. Buyback. A buyback, also known as a share repurchase, refers to a company's decision to purchase its own outstanding common shares from the market. This can be done through various methods, such as a tender offer or buying shares in the open market. The purpose of a buyback can vary. It might aim to enhance shareholder value by reducing the number of outstanding shares, increase earnings per share, signal confidence in the company's prospects, or provide shares for employee stock plans or dividend reinvestment programs. Buy-ins. Buy-ins refer to the situation where an investor who has sold a stock short is obligated to buy back the stock they borrowed and sold, if certain conditions are met. This typically happens when the investor doesn't have enough margin to maintain the short position or when the owner of the borrowed stock demands its return. In cases where the borrowed stock can't be replaced with other borrowed stock, the investor must buy back the shares from the market to fulfill their obligations. This mechanism helps ensure that short sellers are able to cover their positions and return the borrowed shares. Buy side. Buy side is used to describe a segment of the financial market composed of both retail and institutional investors. These investors play the role of buyers, engaging in the acquisition of various securities and availing themselves of services offered by the sell-side counterpart. The buy side encompasses a diverse array of individuals and entities, ranging from individual retail investors to large institutional funds. This contrasts with the sell side, which primarily consists of entities that offer securities, services, and expertise for sale to the buy side. Thank you for joining us on this enlightening journey through essential financial terminologies. We hope you've gained invaluable insights that will serve you well on your path to success. If you found this content beneficial, Don't forget to give it a thumbs up and share it with your fellow learners. Until next time, keep learning, keep growing, and keep reaching for your goals. Wishing you all the success in your financial endeavors.